Yes, the world has moved on, the world has changed. We're having to manage now funds in a rising interest rate environment, a global rising interest rate environment. So that is a significant change for us, and it sort of comes through in a number of different ways. So if we look at around the world, if we start in the US, rates are actually going up. But there's the other component of that is that the QE program, which has been there for a long time, they've still got this book of bonds which are on their books. What are they going to do with them? Are they going to sell them? Are they going to run them off, or are they going to just continue to use the coupons and the principals to reinvest back into the market? We don't know. My guess is that they will start to run those bonds off, and that will have a negative impact actually on bonds generally. Second impact is in Europe, where there have been lots of quantitative easing taking place, and they're just beginning to scale that back. And there's a real debate going on across Europe as to how effective that program has been. Well, clearly one of the consequences of quantitative easing is it means that banks make no money. Banks making no money means that they don't lend money, which slows the economy down. So it's a big debate going on about the overall effectiveness there, and I think we'll probably see some scaling back of quantitative easing in Europe continuing over the next year or so, and perhaps a bit longer. In the UK, we've also had quantitative easing since the Brexit vote last year, and again we would anticipate that they will scale that back. The economy's been doing reasonably well recently, so we might even be seeing the rhetoric changing towards interest rates being increased towards the end of the year. So managing a portfolio in that environment, we've had a long period of falling rates. We've now got to completely change how we respond and how we manage the fund, and as a result we've got lots of short-dated bonds in there, and are even using futures as an overlay to reduce the duration of the fund, to reduce the risk to interest rates. One of the things which is interesting is that, as I was describing, banks make no money when quantitative easing is taking place. Well, the reverse is also true. As quantitative easing comes off, banks start to make money. LIBOR in the US is a 3-month LIBOR is now over 1%. That means that our deposits, which earn nothing for us, that banks pay us nothing, the bank itself is making 1% just on an overnight deposit. So clearly the profitability of banks is markedly higher, and as a result, their bonds are beginning to perform very well. But other areas, financial services are also doing well, because insurance companies, what do? They take money off us, and they may or may not pay us back when we put a claim in. In the meantime, they've got big cash mountains which are now earning lots of money, which before wasn't. So again, insurance companies are doing very well. So there's a new bias towards the portfolio there, much greater weightings. I've always been a fan of banks, but even more so at the moment, because I think that the rewards there are greater than other areas. And if we go back to our point about quantitative easing, one of the areas which has been a big area of purchases by the banks has been corporate bonds. This, I think, has created distorted prices, whereas financial bonds have not been included in those quantitative easing programs. So I think there's been a real advantage there. There is a real advantage there in owning those financials, and not the distorted ones, the corporate bonds, which I think will struggle over the course of the next few months. Our main area, how we reflect the risk of rising interest rates, is by owning shorter dated bonds which are not so sensitive to rising interest rates. Clearly, inflation is going to be likely to be going up. Currency is much weaker. That means that you're going to have to maintain buying power. You've got to work much harder. And we think that using futures as well, which they go up when interest rates go up, unlike bonds which go down when interest rates go up, they hedge the portfolio and protect capital. The outlook is, for all bond funds, there's quite a lot of heavy lifting to do in this environment, because the market is getting used to an environment where a changing environment. It's been a bond rally now going on for 30 years, one could argue. And so there's always concerns about liquidity in this environment. And we've positioned the portfolio to protect against a lot of that potential risk. So I think there are some real risks out there, and hopefully we've put the portfolio in a specifically strong position to be able to protect against those sort of outlier liquidity risks. But where we think there's real value is still in these financials and still in these insurance companies. There are some examples of insurance companies giving yields of 7.5%. You can't get that anywhere else. And there's still some areas of a high yield market which are still offering some real value. So it's becoming a bit more of a sort of special situations fund. I don't want to overstate that, but there's more special situations in the fund than we've had for a long time, because we think that's where the value is going to come, rather than in a blanket ownership of large spectrums of bonds, which could come under a lot of pressure when the market when people start to get a little bit more concerned about the market in the future.